Good morning, everybody. Welcome back to the 16th episode of Coffee with Krav. I started this to stay in touch with you, our clients, and bring you information, education, entertainment on different subjects. Um, we are 1 week from Labor Day, and things have started to open up. And I started this 4 months ago. And after doing this now every single week for 4 months, I'm going to continue with Coffee with Krav, but we're going to change that a little bit. We're going to do it on a monthly basis. So this will be the last week of weekly Coffee with Krav. We're going to start doing it monthly next month. So if you want to jot it down on your calendar, of course, we'll send reminders. We're going to be doing it the first Tuesday of every month at 10 o'clock starting October 6th. So the next Coffee with Krav will be October 6th. So I want to thank all the loyal viewership that we've had over the last 16 weeks. I promise to bring you more content. In fact, I'll give you a teaser for October 6th. We're going to have Matt Long. Matt Long was a New York City firefighter and a terrific athlete. In 2000, he finished his first Ironman race and then set his sights on qualifying for the Boston Marathon by running the New York City Marathon, and he ran his personal best in 3 hours and 13 minutes. Very good. Excellent. However, on the morning of December 22nd, 2005, Matt's life changed in a drastic way. He was cycling to work early in the morning when he was struck by a bus that was 20 tons, making an illegal turn. His doctor gave him a 1% chance of survival. So this is a story that you do not want to miss. So once again, it's October 6th, 10 o'clock on Tuesday. Today, we're going to look into the economic situation here in the United States. We're going to talk about the election and what influences it has on the market. And we're going to do it with Brian Nick. Brian has over 15 years of experience analyzing economic and market data and developing investment strategies for clients' portfolios. As Chief Investment Strategist, Brian is a member of Nuveen's Global Investment Committee, where he works closely with the firm's investment leaders to identify investment trends and provide insights on events driving market activity. He is also a voting member of the Asset Allocation Committee of Nuveen's parent company, TIAA. Previously, Brian was the head tactical asset allocator for UBS Wealth Management America, senior investment strategist at Barclay Wealth. He began his career in market group at the Federal Reserve Bank of New York. Brian graduated with a bachelor's degree in economics and government from Dartmouth and a master's of economics at NYU. He also holds the designation of chartered alternative investment analyst. We have here, and I bring to you, Brian Nick. Okay, so let's get started. Let's start out with the economic picture as it looks right now. We had this pandemic hit us, society closed down, forced us into a recession. We didn't know how long that was going to last. We now have had a huge recovery. Where are we sitting economically in this country right now and worldwide?
Well, first off, thanks for having me. It's a pleasure to be here on the last weekly edition of Coffee with Krav. Well, where we're sitting right now is we're on our way back up, but we're not back to where we were. So when we look at this 20 years from now, looking back on it in some economics textbook, we're going to see a recession that was historical in many ways, historic in many ways. Most, I think, specifically because of its speed. The National Bureau of Economic Research, which is the sort of the ivory tower body that decides when recessions start and when they end, said this one started in February. And if you look at the data, it was probably over by the end of April. May was an expansion month for the US economy. So was June, so was July. August is looking similar. So we're on our way back up, but we're nowhere near the previous peak from the end of 2019, or really, the middle of February in 2020. What has recovered is the stock market, and that's typically what goes down first and what comes up first. Then you have GDP, or national output, that falls just after the stock market starts to fall and bounces just after the stock market bounces. And we've been seeing that since at least May. And then last but not least, you have the labor market, which is the last to start to show true signs of weakness and the last to start to recover. So your definition of kind of where we are depends on what you're talking about, but just the overall level of economic output is recovering very impressively. Consumers are adapting, businesses are adapting to this new normal. Most types of business, most types of commerce can continue to happen under these circumstances where people are not going out as much. There's huge swaths of their former types of day-to-day life or economic activity that they're not able to undertake, but they're finding new ways to get around that. My in-laws never went onto a computer to order anything, never went on Amazon, and now they get half the things they buy from Amazon. That was part of a trend that existed before the pandemic. It's probably going to be exacerbated by this pandemic. I don't think they're going to be going back 5 days a week to go shopping anymore when they can buy all this stuff online. But that is basically allowing consumer spending on a lot of businesses to get through this, I won't say unscathed, but with much less permanent damage than you would have expected were we sitting here in February, March, April talking about how bad this was going to be. That's not true of every sector, though. The service industries, which is a big part of the U.S. economy, are still severely depressed. Anything connected to travel, leisure, hospitality, restaurants, obviously the revenue is not where it was.
That's a small percentage of the stock market, right?
Correct. Larger percentage of the economy, small businesses devoted to services, small percentage of the stock market, vanishingly small percentage of the stock market. So you can find sort of anecdotally, this guy I know who owns a restaurant is really struggling to make ends meet. And he was, helped by the PPP as part of the CARES Act, the Paycheck Protection Program, might have gotten small business loans from his local bank, might be able to take advantage of some of the Federal Reserve programs that the Fed has rolled out. But still, because of the capacity issues and because the overarching concern for the services industry remains the virus, we're probably not looking at a normalization of that part of the economy unless and until we've solved that problem. And I call it a healthcare crisis because it has, many different facets. We can solve it in a couple of different ways with a vaccine that's widely adopted, with some kind of therapeutic treatment, or long-term just letting the virus run its course. So one of those three things is going to be the ultimate end game for this this part of the economy. And unfortunately, we think there's at least another couple of quarters here where those industries are still severely impacted by this.
Do you think that this recovery is sustainable? Do you think that we're at the beginning of a new growth phase? Of course, not counting the airlines and the restaurants and the ones, but other businesses like that.
I think it is sustainable. Yeah, one reason why I think it's sustainable is that consumers are relatively well off going into and then coming out of this recession compared to prior ones. If you look at 2006, average household savings rate was only about 2 or 3%. People had a lot of debt, and that debt was being paid at much higher interest rates. Coming into this one, there's never a good time to have a recession, but the household savings rate heading into this on average was about 9%, which is historically quite high. People's wealth as a percentage of their income was also quite high because housing prices have been increasing for about a decade. The stock market, basically what comprises the bulk of people's nest eggs, has also been, doing quite well in recent years. And so there wasn't as much of a need for consumers to really pull back, de-lever, act very cautiously for not just the recession itself, but for years afterwards, because they didn't have the savings and they didn't have the sort of the accumulated income that people this time around had. So
I want to stay with the savings rate just for a second, because I read that there's more cash sitting on the sidelines. There's more money in checking accounts, money markets, savings, trillions of dollars than we've ever had ever. Can that be a great match that can light the fire of the markets going higher?
Yeah, so what's really interesting about the stock market rally that we've seen since the bottom, and now we're back at all-time highs, or I think close to them as of today's open. You've seen for a period of not just weeks, but months, individual investors pulling their money on net out of stock mutual funds and stock ETFs. So during this entire rally, individual investors have been owning less and less of the market. And that means that other types of investors are in there buying, right? Institutions, longer term, investors. But individuals are not, this is what we call an unloved rally. They're pulling money out of equity funds, putting some into fixed income funds where we're seeing really strong inflows. Maybe people are looking for yield in ways that they weren't before because interest rates are so low. They have to put more into income producing funds. But there's also a mismatch there where, to your point, there's money going into cash directly too. And we know that cash is right now producing close to zero for investors because the Federal Reserve is holding short-term interest rates down at zero. Combine that with the cumulative effect of the fiscal stimulus in the US, and this is not just a US story, but I'll use the CARES Act as an example. We sent $1,200 checks to every American below a certain income threshold, and then we had enhanced unemployment benefits for people, the tens of millions of people who had lost jobs, $600 per week through July 31st. Now, that expired about a month ago now. We can talk about the implications of that. But that caused the savings rate, I said the 9% savings rate going into this recession, it got as high as 26%, and now it's back down to 18. So incomes have been very well supported in this recession in a way that is completely unprecedented. You don't see incomes rise during recessions because the fiscal stimulus response was so powerful. So that's an additional source of the cash that we're seeing sitting in people's checking and savings accounts that they're not necessarily keen to spend because there may be some doubts about, am I going to lose my own job? Is the economy as a whole going to turn south at some point? So there's a lot of caution there. But to your point, there's a lot of dry powder on the sidelines from individual investors. Now, typically, what we see is when those inflows start to come back, when you start to see the ETF funds and the mutual funds turn really positive again, coming from retail investors, that tends to be a sign that the market is getting close to a top. So actually, every week where I see on Wednesday, I track this Investment Company Institute data that comes in on mutual fund flows. Every Wednesday that comes in negative, I kind of, I'm a little bit happy about that because that means that the market typically still has more room to run. There's also an indicator where they poll individual investors about whether they feel bullish or bearish about the equity market over the next 6 to 12 months. Guess what? That poll has come back net bearish continuously since March, even though the market has been going straight up. So it's a pretty good contrarian indicator, actually. When you start to see people get, just average investors become really bullish on the market, that's not actually a great sign. But to your point, if that cash comes back in a very powerful way, that can certainly push the market up even further to an even higher valuation than we've already seen it get to.
So it looks like the U.S. has lost some worldwide luster with the handling of the COVID-19. And as a result, we've seen a weaker dollar. I have a couple questions on that. Is it possible that the dollar can lose the world currency? And will U.S. companies doing business internationally have a leg up because of the lower dollar?
So second part of the question first, the answer, at least in theory, is yes. Although it depends, whether you consider the dollar to be weaker depends on where you start. The initial response to the COVID crisis was for the dollar to strengthen incredibly, in the months of February and March, really when liquidity was the core concern and the markets were kind of bordering on panic. People are flooding into the most liquid and most familiar currency, which is the dollar. So in that sense, to answer the first part of your question, when push came to shove, investors definitely expressed it was a revealed preference for the US dollar and US dollar assets versus other ones. Since then, we've seen basically a reversal of that. The dollar's come back down to earth for, I think, two reasons. One, I think to your point, our handling of the virus crisis itself is, not up to snuff if you compare it to other developed economies in Asia, also in Europe. In most cases, right now, they're in much better shape than we are in terms of the daily case count and also the hospitalizations and the fatalities. So I think there is a sense in which the dollar is getting weaker because there was a concern that would be tied to a weaker economic story. Actually, that hasn't played out yet. The U.S. economy is not showing signs of having weakened in June and July, despite the really powerful second wave that we saw in the South. But the second, I think, really important driver is the central bank policy and interest rates. For a long time, talking probably 5-10 years before this year, the dollar was benefiting from having much higher interest rates in the US compared to Europe, compared to Japan, even compared to a lot of emerging market countries that have been cutting interest rates. And that tends to drive currency valuations. If our interest rates are much higher, we're going to attract a lot more capital from overseas. There's going to be investors in Switzerland who look at the Swiss interest rate in negative territories and say, I'd rather own dollars and get paid something to own cash or to own U.S. Treasury bonds.
Well, let me stay with you there on the foreign investment into the equity market with the dollar lowering or recently lowering, as you're saying. Do you think that foreign investors will be pulling money out of the market, and have they been doing that?
No, we haven't seen foreign investors pulling money out of the U.S. market. There tends to be a lot of momentum associated with those flows. So as long as the U.S. remains the best game in town and the best kind of trailing performance, that tends to be an attractor, a magnet for additional flows coming from overseas. But really, when it comes to like the money markets and the bond markets, which is what a lot of the currency moves are based off of, we just aren't paying you that much more in the U.S. anymore to hold cash, to hold our treasury bills, to hold our treasury notes compared to what Germany or France. We still have higher interest rates than them, but the differentials come in a lot, which is going to tend to, it basically makes the cost of hedging against dollar weakness a lot more expensive, and it drives investors away into other currencies. And that's what we're seeing. The bigger moves in the dollar in terms of it falling have come from currencies like the Norwegian krona, the Swedish krona, the Australian dollar, which have tended to be places where when people are feeling pretty good about the world and they want to get paid a little bit more, they move into these other currencies because they tend to be a little bit higher yielding than the dollar.
Let me switch over to, and we're going to talk about the election a little bit. And also, just as a reminder to everybody, if you have a question for Brian, please email me. My email is mkravitz, KRAVIETZ, at aline, wealth.com. So if you have a question for Brian, please email me. I have my email up, and we'll ask those questions. So let me switch over to the housing market. The housing market has recently been very solid. There's been a lot of activity, especially where I live, Long Island. I've heard down south in Florida and a lot of other areas. A lot of people moving away from the Chicago areas to some of the surrounding areas, and housing's getting a little bit hot. But I did read that we're, due to the lack of building over the last bunch of years, someone had mentioned that we're only in the fourth inning of the housing boom. What's your thoughts, and could we have a rain out and not get past the fourth inning? What's your thoughts on that?
Well, it's been remarkable seeing the housing data come in, whether it's price data, construction, sales, all of it has been, not only good, but it really has blown the doors off of expectations. The not so great news about that is that this is not a large enough part of the overall economic output to really drive growth higher. So we think that, ultimately it's going to be the consumer that is basically decisive in how quickly we escape from this economic hole that we're in. But the housing market is a leading indicator for other parts of the economy, because if you're out there, moving it from an apartment into a house, you buy the house, you have to fill it with stuff, which means you're going to go out and spend money. So when we see a lot of new home sales, existing home sales, pending home sales, which means people that are kind of entering into contract now, about to close, that's a good sign for what consumer spending is going to look like over the next 6 months or so. So right away, much better news than we saw. And compare this to the 2009, 2010 kind of escape from that recession. The housing market was still completely on its back because we'd overbuilt for so many years. What you're seeing now, I think to your point, is a kind of a catch up in home construction. We're seeing building permits, which is a leading indicator for construction. We're seeing architectural hirings, which is a leading indicator again. All these things are improving a lot. And this is a part of the economy that was really missing from the recovery story for at least 4 or 5 years after the end of the last recession. It's very much going to be a part of this one. It should be helping the confident consumer, open his or her wallet again to get the economy moving overall. I think what you're also seeing is sort of this shift that was going to need to happen anyway at some point, where you have people in their mid 30s, late 30s, even early 40s moving out of small spaces in the city into the suburbs. This particular crisis and the pandemic associated with it is probably going to nudge more of those people out of the cities, who eventually I think would have come to places with more space like the suburbs anyway. But I think that may be happening more quickly now. because of the work from home dynamic. I live in the suburbs on Long Island. I haven't really, for the purposes of work, been leaving my house very much. And I think you'll see more people kind of opt for this type of lifestyle as well. So I think that is probably in the short term leading to more sales, which could have in turn lead to more spending. But I think it's probably condensing what would have been a 5 or 10 year trend anyway into a period of just 1 or 2 years.
I didn't realize you're a Long Islander. Where are you?
Garden City.
Garden City, very nice, very nice. So let's talk about the election. London-based Betfair Exchange lowered Biden to -105 and moved Trump to +105, basically saying that it's a toss-up. And they said it was the biggest convention comeback in political betting history. What's your take on that?
Yeah, so I look at it's a little bit different the way that I look at betting markets too, because they're telling you, people who are putting their money on the lines, here's how they're feeling about things, which I mean, that's a lot of what markets are, right? It's people's how they're feeling about how things are going to go and whether prices are going to go up and down. We saw the same thing in I look at Predict It, which is not especially deep or liquid market, but it does kind of move in line with kind of my intuition as well. So you saw Biden sort of peak out at a 62% chance before the conventions. He got as low as 55 after the end of the Republican convention, and now this morning he's back up to 58. I think what you're seeing there is I think investors or bettors feeling like they know something is about to happen, perhaps in the polls. Maybe Trump's going to get a bounce from the Republican convention. Maybe some of the civil unrest that we're seeing in places like Kenosha and Portland somehow redound to his benefit because he's seen as stronger on the issue. We're not seeing that yet in the opinion polls, though. What I would wait for, if I'm analyzing the election as sort of a probabilistic scenario, I would wait to see what the opinion polls look like after Labor Day. We'll get a sense of how things shook out with both conventions, which were not widely watched, by the way. Neither convention got huge viewership. Obviously, the kind of the unconventional online nature of it, I think, was probably a little bit more difficult in terms of kind of producing a show that people are going to watch every night than the traditional big arenas and raucous crowds. I think the race before this was, I'd say, tilting towards Biden. He had a moderately large lead, somewhere in 7 to 9 percentage points, around where Obama was in 2008 against McCain, and that ended up being not a particularly close election. I think you could see it tighten to 4 or 5 points after the convention, but then the question is, how did it shake out afterwards? And I think the betting markets are anticipating movements in the polls that we're not seeing yet. What's not moving, based on, I think, the election outcome seeming to change in the betting markets, is the financial markets. I can't really see many places where you're seeing clear, decisive movements in a sector or in an overall market based on how the election is swinging.
So before you get there, let's talk specifically about that. I'd love to know, and I think we all would love to know, what the market implications would be for Trump victory and the market implications would be for Biden victory.
So I think this would be a much clearer question to answer if we had, say, no pandemic and it was Bernie Sanders against Donald Trump, because you have, I think, much, sort of more polarized policy outcomes potentially, and you don't have the virus, which is going to be the overriding concern for whoever is in the White House in 2021. So I think the clarity on what kind of policies we're going to get based on the outcome in 2021 is not that high compared to where it would normally be, because I think the imperative is going to be continuing to help the economy, even though we talked in the first part of the session about the economy being back. There's still all these parts of the economy. There's all these service workers, tens of millions of service workers, who are probably not going to be back to work, or even most of them back to work by the time the next president takes the oath. And that is going to be job number one on that president's desk. So big fiscal stimulus package, probably some kind of infrastructure package to get people back to work. More aid to state and local governments, I think, is probably going to be on the table as well, and probably more assistance to small businesses. So different versions of what you've already seen, I think, just getting renewed next year. And I think the probability is that if you get an election where there's a clean sweep and you have a Biden presidency and a Democratic Senate, that package looks bigger because Democrats just this, in the last couple of months, passed a much bigger stimulus package in the House compared to what the Senate was willing to vote on and what the president was willing to accept.
So let me ask.
Yeah,
So do you think that we'll get a stimulus package before the election? And if you're saying that if the Democrats do a sweep, there'll be another stimulus package after?
I think
Is
that's
that how
right.
you look
Yeah.
at it? Okay.
I think the odds that we get nothing before the election are certainly going up every day that goes by, and Congress is not even really in session. But the government does, believe it or not, the government is set to shut down at the end of this month. Now it's September 30th. And as part of a continuing resolution, because I don't think anybody wants the government to be shut down going into the election, as part of that continuing resolution that punts us over into November, you'll probably see some stimulus package. You'll probably see some renewal of unemployment benefits, enhanced unemployment benefits, perhaps some deal to keep the airlines and some of the other distressed industries afloat, and something for state and local governments as well. But I think it's going to be, relatively small potentially, given how far we've now gone without that fiscal support, through the months of August and now into September. And I think what you'll see is in January, February, something bigger, probably regardless of what the outcome looks like, because I think the economy is not going to be back in January and February of next year. So the next president, having just been reelected or newly elected, is going to, because he's going to want to do something to show that he helped the economy. And whether the Congress is more favorably disposed towards doing that or not will depend on, again, the individual Senate and House races. But I think you will see something bigger next year, I think, at this point to help the economy. And then the policy.
Do you think
Yeah.
that if Biden gets in and Republicans hold the Senate, do you think that they can still get that through, that second help?
That's the trickiest scenario, because if you
Yeah.
go back in time when you've had a Democratic president and at least partial Republican control of Congress, that's where you can really start running into the austerity scenarios. We had one sort of unintentionally in 2013 with the sequester. If you remember that was an across the board cut in discretionary spending, and that probably lowered GDP growth for about by about half a percentage point per quarter for about a year and a half. So that had a meaningful impact on growth, because you weren't seeing federal government spending rising, and the economy was not in wonderful shape at that point anyway. If you do get gridlock on more fiscal help, I think it could lead to some downward revision in our expectation for how the economy does next year. But I think Biden's approach might be different than Obama's. He knows the Senate a little bit better. I think getting nothing in that scenario, getting absolute gridlock, is probably a lower likelihood than it was, say, after Obama was reelected in 2013. So I'm hopeful that something will pass next year, regardless of the outcome. But I think the outcome that gives us the biggest fiscal stimulus is probably the blue wave D-sweep scenario.
Okay, well, in staying with the election in 2000, there was a contested election. The battleground was in Florida, if we all remember. We didn't have a final answer until December 12th, which happens to be my birthday. Remember that, everybody. Market initially lost 5%, but then the markets did rally after that. What's your thoughts about a contested ballot, especially since there's going to be a fair amount of mailed-in votes, so that alone lends itself to the possibility of some questioning. So what's your thoughts on that?
Yeah, I think that there's two possibilities. One is that we just don't know the outcome, because there's so much of a mail-in vote that needs to be counted. So we don't know the outcome the night of the election. And I think the markets can deal with that type of uncertainty. I think it'll also be somewhat priced in. If you look at volatility futures, this is not the most kind of, it's sort of an obscure market, but if you look at the volatility in the market right now, it's actually been quite low. But the future volatility that's implied by these markets is much higher. And I think some of that's because there's some risk being priced in that we don't know the election outcome on day one. And the other possibility is that you get the election night vote looking like it's going to be one way, and then as the ballots come in and shift over the next week or 2 weeks, it looks like it's going to go the other way. And that is very possible, I think, based on just the opinion polls and who's saying they're going to vote when. That would be in a scenario where the market probably has to go from pricing in one outcome to pricing in another one. And that could also be coupled with just general kind of civil unrest in the country. If there's really, people fighting over the ballots, or a lot of different places where the election is uncertain, not just Florida, but Wisconsin, Pennsylvania, Arizona. There's a lot of places where we could see, contested state ballots. So that's not a wonderful scenario. I don't know that it drags into December, because then you have court proceedings that you had in Bush v. Gore that maybe you don't necessarily have here, because the margins may not be close. They may just shift with the mail-in ballot counting. The other thing you had in 2000 was the economy was sliding into recession. So some of the market behavior at the end of 2000 into 2001, I think, reflected that as well. And the very, very toppy, we didn't know it yet, but post-tech bubble valuations that were starting to come back down. So it's not a kind of an apples to apples comparison in terms of how the overall economy is doing. But do I think that we could be in for, basically kind of flat markets and a lot of risk aversion in November, December, pending the outcome of the election? I think that's a very good possibility. But the market certainly is not showing trepidation heading into November. We're not seeing any of that. We saw that a little bit in 2016. There was kind of this several month period where things didn't really go anywhere. Stock market is behaving very confidently right now, even though the betting markets are sort of saying we don't really know what's going to happen.
Okay. Let me shift over to the coronavirus, where we are today. What's the possibility, in your thoughts, of a second wave? And also just wanted to get your thoughts on the vaccination.
Sure. So on the vaccination, what I've been hearing from sort of the healthcare experts that I think have sort of a built-in bias towards being conservative, small c conservative, on saying that this kind of thing is coming. I've actually heard much more confidence coming from them, both people inside and outside of government, than I would have expected. People who would, I think, for whom it would pay to be cautious and not to raise expectations too much, are saying that by the end of this year there could be a real candidate for a vaccine that could be put into widespread production, and then by, say, the first half of next year, you have a lot of people who have taken it, because it takes time to ramp up, and then convince people that it's safe to take. So you have a widespread, vaccination. That is I think, if there's any kind of silver bullet toward getting the economy back to normal quickly, it's that, right? My whole family has been vaccinated. We're going to finally take that vacation to Europe or to Disney World or wherever it is we were planning on going. And I think we see the second half of next year as really being the period in which the economy can get back to normal or get back on trend. And that assumes that we have some kind of a healthcare solution, that we're not just, kind of everybody's walking around wearing masks and movie theaters are closed and restaurants are at quarter capacity. I don't think that's really the path that gets us back to normal. It really involves, again, some kind of not cure all, but a widely adopted vaccine. The likelihood of a second wave, it just feels like we've been having regional waves, the Northeast and then the South, and now it feels like parts of the Midwest are starting to be more affected by the coronavirus. What I would point out, though, is that each subsequent wave seems like it's a little bit less deadly than the one before it, and consumers are adapting, right? People are walking around wearing masks. They're going about more of their daily business, certainly around here on Long Island, than they were in March and April, where you didn't see anybody kind of walking around on the streets at all. So not everything can come back under the status quo scenario, especially if we get more virus scares in parts of the country that have already been hit. I think you'll see people adapt their behavior and probably not get as much toward kind of that double dip recession scenario, I think, as many fear. We were talking about a double dip, a W-shaped recession for the economy, back in March and April, and we just didn't know what the pattern was going to look like. But to me, this feels like we got through this one period where the economy was basically shut down. People, stay at home, and we're not going to go back to that again. We're going to adapt, and we're going to have, restrictions certainly in place, but not a wholesale kind of shutdown or a complete, stay-at-home order for the U.S. economy, even in regions where it's, the virus is spreading and is bad, because we've learned some lessons about what we do need to shut down and protect and what we don't. And I don't think we're going to see as much of an economic shock, let alone a recession, to future outbreaks regionally here as we did in the initial one.
That makes a lot of sense, and I've talked to doctors around the country, and they've said a similar thing. Now, you mentioned the movie theaters just before, and it looks like movie theaters are starting to open up. It's kind of hard to eat popcorn though with that. But what's your thoughts? I mean, would you go to the movies? Are people going to the movies? I know it hasn't opened up here in New York, but
Yeah.
there's other places that it has opened. How has that looked, and what's your thoughts on that?
So I'm a huge movie buff when I'm not doing economic and market prognostication and analysis. I'm probably watching a movie. So this has been a tough period for me in terms of not going to the movies. I actually did go to the movies. We were up in Saratoga Springs in New York, and there was a drive-in theater. I took my kids to see
Oh,
Ferris Bueller's Day Off. So that's not a new
nice.
movie. Um,
No, that's a good
but
one.
there was a new movie playing across on a different screen, the Russell Crowe movie Unhinged, and there were a lot of cars parked up. So the where theaters can show films in the United States and around the world, people are going to see them, but they're not high capacity, right? So this is a really good microcosm for a type of industry that I think people look around and they see, gosh, here on Long Island, all these movie theater chains are shut down. How are they going to survive? This is a calamity. And it is for those companies, but these are not large companies that play huge roles in either the economy or the equity market. So this is where you kind of have to, what you see and experience on a day-to-day basis, separate it from your assessment of the overall economy and then your decisions as an investor, right? Because AMC theaters or Regal Cinemas is having just about the toughest year I think any of us could have imagined, given how few of their theaters can operate and open. But this is not having a material impact on the overall economy. Yes, you can see that line item in GDP for leisure and theaters is like falling off a cliff, but it's not an overall large part of economic output, and it's an even smaller part of the stock market. So yes, and again, it's a microcosm for the overall services industry. Airlines are a much bigger deal. Hotels are a much bigger deal. Theater chains sit somewhere, a little bit lower down on the pecking order in terms of importance to the U.S. economy. But what I think we're seeing is an acceleration as a result of this prolonged closure toward online viewing, streaming. Disney Plus came along just at the right time, at least for my family, and I suspect for many others as well. And you're gonna see more efforts on the parts of companies that have these existing streaming platforms like Disney, like Amazon, like Netflix, to sort of try to monetize that. Disney they're already going to try to get me in a couple of days to pay $30 to see Mulan, the live action Mulan that was supposed to be in a theater. I haven't made a decision on that one yet, but they're going to be looking for ways, because they have this huge hole in how much the revenue they expected to generate from these Disney-owned properties in the theaters, whether it's Black Widow, Spider-Man, Mulan, all these movies that were slated to come out and are not probably going to get wide releases now. What are they going to do with them? So it matters for these much larger companies as well in terms of their sources of revenues. The thing I'm keeping an eye on is overseas, where you have more theaters open because there's just not as much spread in the virus. So you look at places that are comparable to the U.S., like mostly Western Europe, but also Japan. I did a movie there that a lot of people are looking forward to called Tenet, the Christopher Nolan movie. He did the Batman films. He did Dunkirk a couple of years ago. That made $50 million worldwide over the last weekend, and none of that was in the U.S. It's opening this weekend. So I don't think those who are proclaiming the death of the movie theater and the movie theater chain, that may be a little bit, premature. But for sure, even if you're packing these theaters to capacity, which is probably about 1 out of every 4 seats filled, and you have all the markets open, which you don't right now in the U.S. You have only maybe 4 out of the top 20 markets that are even showing films at this point. You're not going to see anywhere near the level of revenue generation, which is going to make a big deal for the studios and also for the theater chains as well. And what the last point I make is what you're seeing now is that the distributors and the movie makers are asking for more concessions from the theater. Please let us put this movie on streaming sooner than we would have. Otherwise, it used to be a 90-day window before you could take a movie that was in the theater and put it on demand or streaming. They're asking for that, and they've gotten this concession from some theater chains to be shifted down to about 2 weeks. So that puts theaters under even more stress that they're not going to have sort of that monopoly control over the film. So this is probably an industry that I follow more closely in proportion to its importance than I probably should or need to. But I think it's a pretty good microcosm for here's how the virus is still affecting important parts of the economy, consumer behavior. The really regrettable thing is movie theaters are normally recession proof. Movie theaters normally do great during recessions. In 2009, 2008, movie theaters had great years because people are not doing things like going to Broadway shows, for example, or taking their families on vacation. So what can you do as kind of a fun alternative? You can pay, $15 or probably more than that if you're getting popcorn and soda to bring your family to the movies. And that obviously they have not enjoyed the benefit of that at all this year because they've been very much at the center of the recession.
I have a question from Erwin. Erwin, thank you for the question. Do you see the travel industry recovering anytime soon?
If anytime soon means by the end of this year, then I think no. I think you're going to continue to see pressures on global governments to support airlines, to support other industries that are tied to travel, perhaps like hotels as well. That was part of the first CARES Act. So there's a recognition that the unique nature of this recession calls for, I think, targeted assistance to these industries. I still think, and you've already seen some of the hints that this is going to happen, you're going to see, I think, some potentially widespread layoffs in these industries, especially if that aid expires to the airlines at the end of this month without being renewed. You are seeing, however, I think some hope priced into the market prices of the shares for these companies that there can be a relatively quick turnaround if there is again, a silver bullet solution to the healthcare crisis. And I think that, I've been saying, I think that means a vaccine. It could mean a really powerful therapeutic that basically, cures people who have the virus as well. But I think the vaccine is really the way to unlock revenues and, traveling volumes of travelers sometime by the middle of next year. But I don't think you'll see anything normalize for these industries until at best next summer. We don't have international travel at the moment. That's going to take, I think there's going to be countries under some political pressure to not open up that quickly and accept people coming from other countries. That's going to put a dent in those revenues as well. And we've already seen a lot of the routes that these airlines have taken also cut back. So even getting back to full capacity on airplanes, they're not running as many routes as they used to either. So again, that is going to impact revenues as well. Optimistically, I'd say, could these industries be back by the end of next year? I think that still looks optimistic. If you look at where we're investing, we're not heavily invested even in the distressed debt or credit of these companies, let alone the equity. These are not places where we're taking a lot of risk at the moment. And if we saw a solution or a return to normal for the travel industry by the end of next year, we would be investing more heavily. But it looks like it's going to be pushed out a couple more years before they're really fully back.
So for Erwin's question, because he's a major traveler. In fact, where's Waldo? I would say that about him. He's been everywhere and then some. It sounded like maybe next summer before things will get a little bit normalized, where Erwin and others can start traveling.
Yeah, I think
it's dependent on the vaccination as well.
Yes, I was addressing more of from a kind of an economic and a market standpoint. But from somebody who wants to travel, I think optimistically, if you can kind of show, if you want to fly to say Europe and you can show that you've been vaccinated or that you have this test that's done, I think middle of next year would be when I'd see that starting to reopen.
And will the cruise line be the last industry to recover?
Yeah, that's a tough one. Some of that is also a little bit political due to kind of where these companies tend to be domiciled. So there's less, even though a lot of the passengers tend to be American, the companies aren't necessarily, so they're not as politically attractive and to help in terms of the direct spending coming from Congress. And that is a knock against them as well. And I think that maybe, as opposed to airplanes, cruise lines may be less attractive to travelers who are kind of dipping their toe back in the water. They may prefer to drive somewhere or fly somewhere and not take that cruise. So I do think there's more existential risk for the cruise line industry than there is for the airline industry.
Okay, good. I'm going to do a lightning round, which I've only done with a few people over the last 16 weeks. So ready for the lightning round? You're all set?
Let's go. I'll try to keep it short.
Okay. Ready? Yankees or Mets?
Yankees.
Beautiful. All right. I knew I liked you. Okay.
My dad grew up in the Bronx, so there you go.
Oh, okay. Beautiful. Godfather 1 or Godfather 2?
Oh, wow. Godfather 1 because of Brando.
Okay. Austin Powers 1, 2, or 3?
1.
Austin
Definitely
Powers
not
1.
3.
Okay. Hey, that was a good one.
You know, a lot of young people have never heard of Austin Powers.
Is that
I
right?
make Austin Powers jokes, and people who are under like 35 don't get it. They've never seen the films.
Well, they got a lot to look forward to.
Yep.
Okay. What's your favorite movie?
I don't want to sound like too much of a nerd, but I'm a huge Star Wars fan. I say Empire Strikes Back.
Empire Strikes Back. Good. Okay. Netflix, Prime, or Hulu?
Netflix.
Netflix. Okay. At the movies, do you go with candy or popcorn?
Popcorn.
Popcorn. Okay. Rolling Stones or the Beatles?
With a mask on.
With
Beatles.
Beatles. All right. And favorite band?
Dave Matthews Band.
Dave Matthews Band. Beautiful.
You can
Okay.
tell probably how old I am just from that answer.
Right.
It's a narrow window.
All right. Trump or Biden?
To win, looks like Biden.
Okay. Do you think the market will be up or down from now to the end of the year?
Up.
Up. Okay. And where do you see the 10-year interest rate in 2021? Where does that end? Where do you think that'll be?
End of next year, I think will be at the end of next year. I think we'll be. I'll call it 1.25%. I think we'll be higher than we are now, but nowhere back to what we would call normal.
Okay. All right. That is the lightning round. Unless we have any questions from the audience, I have one last question for you. I saw, reading your notes that you deal in asset allocation. Is there any particular area that you're looking at that there's an opportunity from an asset allocation standpoint that we can take advantage of today?
Yeah, so I'd start by saying that the sort of the classic portfolio, whether it's 50-50 or 60-40, has performed really well over the last 10 years and really over almost any time horizon. So U.S. stocks, higher quality U.S. bonds has been kind of the hard to beat from an asset allocation standpoint. It tends to be when you add more things to that, it's caused things to perform less well for you. I don't think that's going to be the case moving forward. So when we're looking at places to add to an asset allocation, the S&P 500 looks expensive. The U.S. bond market looks expensive. So where else can you go? We like emerging market credit. That doesn't necessarily mean you have to be in these emerging market currencies. A lot of this debt's issued in dollars. That's one area that we're favorably disposed to at the moment. We don't think real estate is dead either. So owning real estate in a portfolio, yes, retail is in trouble. Yes, parts of the office space may be affected by the work from home shift. But you look at industrial, a lot of which are just kind of big warehouses and logistics centers that are oriented around e-commerce. I wouldn't bet against e-commerce growth over the next 10 years. And a lot of the areas that we invest in for real estate are around that specific dynamic as well. So those are two areas, especially if you're looking for income, which a lot of investors are, that I would consider adding to a portfolio at this point if you haven't already.
How about EM equity?
Yeah, so usually the case for EM equity is usually that it's cheap and it's high growth. I think right now it's harder to argue that it's cheap because earnings have been so dramatically affected in EM. We really have to see evidence that they're kind of starting to come back. So I wouldn't say banking on cheap valuation is the way to go with EM or really any equity market around the world, but the growth ought to still be there. China is the first economy to bounce back. A lot of EMs have much more kind of contagion or ties to China than they do to the United States. And the fact that China is now in kind of month 5 or 6 of a recovery and is continuing to post pretty good data, I think that's a positive sign for emerging markets overall. I would invest specifically in places that are more economically tied to China.
Okay. Well, Nick, Brian, Nick, thank you so much for your time, your effort. Really appreciate it. Everybody out there appreciates the knowledge that you've given us here today. So I want to thank you for coming on to Coffee with Krav. Really appreciate that. For everybody out there, just as a reminder, today will be the last segment of the weekly Coffee with Krav. The next time we will see you will be October 6th. So once again, we're going to be doing this Tuesday, the first Tuesday of the month at 10 o'clock. So we will see you Not the same bat time, not the same bat channel, but we will be doing it monthly, Tuesday, 10 o'clock, and we have a talk with Matt Long. You do not want to miss that. That's great. Tell your friends, tell your colleagues, tell others, tell anybody, tell your family. It's going to be a great one. I will see you then. Take care. Thanks, Brian.
Thank you.
Bye-bye.